Hello, and welcome back to AlgoBot, your channel for clear, practical breakdowns of automated trading strategies for MetaTrader 5. I'm your host here at AlgoBot, and today we're exploring an expert advisor called the Semivariance Reversion Fade. This is an asymmetric mean reversion strategy built around an adaptive volatility envelope. By the end of this video, you'll understand how it measures downside and upside volatility separately, how it hangs an uneven set of rails around a moving average fair value, and how it looks to fade overstretched moves back toward the mean. Everything here is for educational purposes only and never financial advice. Let's dive in. So what does the Semivariance Reversion Fade actually do? At its heart, it is a mean reversion approach. It assumes that when price stretches unusually far away from a central fair value, it often drifts back toward that value. Classic envelope systems, like Bollinger Bands or standard deviation channels, measure how far is far using a single, symmetric number. That means their upper and lower boundaries are mirror images of each other. But real markets are rarely so tidy. Downside moves and upside moves can have their own characteristic speed and size, a feature traders often call volatility skew. This strategy leans into that idea. It borrows the thinking behind the Sortino ratio and measures the two sides of the market separately using something called semivariance. It looks at recent percentage returns, splits them into the moves below average and the moves above average, and computes a downside deviation and an upside deviation independently around an exponential moving average baseline. It then hangs an asymmetric envelope. The lower rail is scaled by the downside deviation, and the upper rail is scaled by the upside deviation. So the two boundaries can sit at genuinely different distances from the center. The clever part is how this self-regulates. In a sustained sell-off, downside deviation balloons, the lower rail drops far away, and casual attempts to fade the decline naturally stop firing, which is exactly when fading a falling market would be most hazardous. A second filter, the TrendGuard, watches the slope of the baseline and steps aside entirely when the market is grinding directionally too fast. Who is this style of strategy suited for in an educational sense? It's aimed at traders who are curious about volatility modeling and mean reversion, and who want to study how an EA can adapt its boundaries to changing conditions. A natural testing home is a liquid foreign exchange major or a metal on the 15-minute through hourly time frames. And of course, like all trading, this approach carries real risk, and losing trades are a normal part of the picture. Let's walk through the mechanics step by step. Everything runs once per newly closed bar, so the EA is patient and only acts on confirmed candles. First, it builds its fair value. It calculates an exponential moving average of the closing price over the mean period, which defaults to 20 bars. This baseline is the anchor for everything that follows, and it will also serve as the profit target. Next, it measures volatility, but asymmetrically. Over the dev period, which defaults to 40 bars, it computes simple percentage returns. It finds the average return, then separates the moves that fell below that average from the moves that rose above it. From the below average group, it derives a downside deviation, and from the above average group, an upside deviation. These two numbers can differ, and that difference is the whole point. Now the envelope is built. The lower rail sits at the baseline reduced by the down multiple, defaulting to 2.2 times the downside deviation. The upper rail sits at the baseline raised by the up multiple, also 2.2 by default, times the upside deviation. Because each side uses its own volatility, the rails are genuinely uneven. Then comes the TrendGuard. The EA measures the per bar slope of the baseline. If that slope is steeper than the TrendGuardAtr, defaulting to 0.3, multiplied by the current ATR, the strategy concludes the market is in a strong directional grind and stands aside completely. If the market is calm enough, the EA checks for setups. For a long, the strategy signals when a freshly closed bar closes below the lower rail, meaning it is overstretched to the downside, and that same bar is bullish, closing above its open, which suggests the snapback is already beginning. For a short, it is the mirror image. The bar closes above the upper rail and is bearish. Risk is defined immediately. The protective stop is placed at the ATR stop multiple, defaulting to 1.8 times ATR beyond the entry. The take profit is the baseline itself. Before committing, The EA checks that the reward to the baseline divided by that risk clears the min-reward risk floor of 0.8. It also skips entries when the spread is wider than max spread points, and it holds only one position per magic number. Finally, exits are adaptive. Because the baseline keeps drifting, the EA closes a position the moment a later closed bar prints back through the current baseline, banking the completed reversion. Let's read through the code as it appears in MetaTrader. At the top are the input parameters. MeanPeriod sets the length of the exponential moving average baseline, and DevPeriod sets how many returns feed the semideviation calculation. DownMult and UpMult control how wide the lower and upper rails sit, each scaled by its own side's deviation. TrendGuardAtr governs the slope filter, ATR period and ATR stop multiple shape the protective stop, and min-reward risk is the minimum reward to risk the setup must clear. Max spread points, lots, and magic round things out. Just below, you can see the two rails being built. The lower rail is the baseline multiplied by 1 minus DownMult times the downside deviation, and the upper rail is the baseline multiplied by 1 plus UpMult times the upside deviation. Now the long block. The condition reads, if the closed bar's price is below the lower rail and the bar is bullish. When both are true, the EA reads the ask price as the entry, sets the take profit to the baseline, and places the stop distance below entry. It then checks that reward divided by risk meets the minimum before calling trade.buy. The short block is the exact mirror. If the closed price is above the upper rail and the bar is bearish, the EA reads the bid as entry, sets the take profit to the baseline, and places the stop distance above entry. After the same reward to risk check, it calls trade.sell. Both sides target the same drifting mean. Let's bring the logic to life on this illustrative chart. Notice the three lines drawn over the candles. The gold line running through the middle is the exponential moving average baseline, our drifting fair value. The green line below it is the lower rail, scaled by the downside semi-deviation. The red line above is the upper rail, scaled by the upside semi-deviation. Because each rail uses its own side's volatility, they need not sit the same distance from the baseline. Watch how price interacts with them. At the far left, the market is drifting gently lower. The first couple of candles are soft, red bodies stepping down toward the green lower rail. This is exactly the kind of stretch the strategy is built to notice, but notice too that it does not rush in. The strategy is waiting for two things to line up at once. On the third candle, price pokes below the green lower rail, showing it is overstretched to the downside relative to normal downside volatility. But crucially, this candle also closes above where it opened, a bullish body suggesting the snapback may already be starting. Both conditions are now satisfied, and the trend guard confirms the baseline is not grinding down too steeply, so the strategy signals along. You can see the buy entry marker sitting right at that rail-piercing candle. The stop is placed a set distance below, based on the ATR, and the take profit is set at the gold baseline itself. Now follow the recovery. The fourth candle turns up firmly, and the fifth candle pushes back into the middle of the range, tagging the gold baseline. That is the mean reversion completing. Because the baseline is the target, the take profit marker appears here as price reclaims fair value. The completed move is banked, and this is also where the adaptive exit logic would close a winner if the target had not already been reached, since price has printed back through the current baseline. Price does not stop there. Over the next several candles, the market pushes higher, green bodies climbing away from the gold line and toward the red upper rail. This sets the stage for the mirror image trade, the short side. On the candle marked for the sell, price closes above the red upper rail, meaning it is now overstretched to the upside relative to normal upside volatility. And this candle is bearish, closing below its open, a sign the advance may be rolling over. With the trend guard confirming no violent upward grind, the strategy signals a short. The sell entry marker sits at that upper rail rejection. The stop is placed a set distance above, again scaled by ATR, and the take profit is once more the drifting gold baseline. Watch the fade play out. The following candles turn lower, stepping back down through the range until price meets the gold baseline. The take profit marker appears as the mean is reclaimed from above, completing the short. Before either trade was taken, The strategy also checked that the distance to the baseline target compared with the stop distance cleared the minimum reward to risk floor of 0.8, and that the spread was acceptable. So in one clean sequence, you have seen both halves of the semivariance reversion fade. A long fired when price overstretched below the volatility scaled lower rail and began snapping back, and a short fired when price overstretched above the upper rail and began rolling over. In both cases, the goal was the same, a return to fair value. And in both cases, remember, a stop was waiting in the other direction, because not every fade reverts, and losses are a genuine part of this style. That brings us to the end of our look at the semivariance reversion fade. Today we unpacked how it separates downside and upside volatility using semivariance, how it hangs an asymmetric envelope around an exponential moving average baseline, and how it fades overstretched moves back to that fair value, with a trend guard, an ATR stop, and an adaptive mean reclaim exit. We also read through the actual MetaTrader 5 code for both the long and short signals. As always, this video is educational content only, and not financial advice, a recommendation, or a solicitation to trade. If you found this breakdown helpful, please like the video, subscribe for more MetaTrader 5 strategy analyses, and leave a comment telling us which strategy to study next. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.